Due diligence, as the unit introduction pointed out, is the core fundamental in fundamental analysis. It is with the skill of stock-specific due diligence that you will develop your research and ultimately your trading ideas. This section deals with stock-specific fundamentals that are used by all successful traders, whether they are directing trading from a corner office on Wall Street or from the kitchen table. Earnings, growth trends, financial health, management performance, and intrinsic value are the core indicators of performance and organizational soundness. You will use these indicators, after defining your own personal parameters, to determine what stocks will and will not be on your watch lists. As was said before, the most important, impacting, and certainly the most watched fundamental indicator of all is that of company earnings. The bottom line is the bottom line of any equity or derivative investment, even those investments made in companies that are making no money at all. A prime example of this is Google. At the time of Google's IPO, it was a solid company, but had not once formally announced earnings. Millions of Google shares were bought, not based on what Google's earnings were, but what they were expected to be in the future. I will leave you to decide if those purchases were a good move or not. Listed here are 4 sites where you can find earnings information for any company that is publicly traded. Any company that is registered with the SEC is required to report earnings 4 times per year. Knowing when those announcements are to come will be important for effective trading, as the impact of an earnings announcement can have significant impact on stock price. Here is a prime example of what I'm referring to with regards to the importance of earnings announcements. This is a screen capture of the earnings record for Yahoo from earnings.com. The most recent report from Yahoo was expected to be a profit of 13 cents. But the actual announcement was 17 cents per share, 3 cents above analyst estimates. To see how much impact that had on the stock price of Yahoo, look at the change in the chart for Yahoo on the day the announcement was made. The chart shows what is referred to as a breakaway gap. This is a time when the price of the stock rises or drops so quickly that there is no progressive flow from price levels. As you see here, the price of Yahoo just before the announcement was below $11 and rose to over $12. A dollar increase on 10 shares would have been a profit of $10. A dollar increase on 10,000 shares, or the control of 10,000 shares, for which options trading allows, well, you do the math. Obviously, each time a company declares earnings, the stock is not going to have a dramatic swing. But every time a company declares earnings, it will create potential volatility. Volatility will be discussed in depth in the last unit of instruction, but for now, consider volatility to be a very tight spring compressed to one degree or another through pressure created by the market. When the market pressure is released, the uncoiling of the spring releases volatility and can have a significant swing in the stock price. Therefore, until you are very familiar with both the organizations you are watching and the techniques of options trading, it is strongly suggested that you not hold an investment that crosses the earning dates of an organization unless it is a long-term investment that has time to recover. Going with the positive flow simply means staying connected to the stock you are considering trading. Know the fundamental indicators of your equities so well you could all but recite them verbatim. That way, when something changes, you will not only be aware of it, but you will also have a good idea what will happen to the stock price if and when it occurs. A fundamental shown here, but not previously discussed, is percentage of institutional ownership. Institutional ownership is not unto itself a fundamental, but it does say quite a bit about what the fundamentals may indicate. An institutional owner refers primarily to managed fund accounts like your 401k and any of the hundreds of mutual funds available. Many of these organizations have organizations under their roof which have the single task of market research, down to the individual sector, or in the case of equities like Walmart or Google, the specific stock. If those organizations feel that a stock is worthy of being bought, that says a great deal about the fundamentals of the company, as does the lack of institutional ownership. Another factor of institutional ownership has to do with the stock price movement. Without institutional level ownership, the stock can be passive. While that is great for the long-term aspect of trades, it does not create the environment where options can be very profitable. To benefit from the amount of volatility that is needed to keep a stock moving, it is generally accepted trading principle to not invest in companies that have less than 50% institutional ownership. One of the primary objectives of this course is to introduce you to investment tools that are available to you on the internet at absolutely no cost. 3 highly regarded and heavily used sites for stock information and for investing in general are listed here. Quicken.com, Finance.yahoo.com, and CBSMarketWatch.com are all 3 excellent sites and will provide a great deal of information. Finance.yahoo.com is an excellent site. The site contains a great deal of information that can be quickly gathered just by scrolling down the page, not to mention actually following the links. Be assured that in no way am I suggesting that this or any other single site should comprise the total of your stock due diligence research. However, it is a good idea to find 1 or 2 sites that you prefer and use them often. To access stock-specific information, scroll to the top of the page and enter the stock ticker symbol, which for Yahoo is YHOO, and select the Get Quotes button. This stock screen represents a commonly found layout for stock information. Although there is quite a bit of information shown, the important parts are the last trade, the daily and 52-week trading range, and the volume, which shows how many shares were bought and sold. If you are keeping up with stocks as you should, a simple look at this screen would allow you to know if the last trade was within the range of previous trades, a very important piece of information if attempting to identify a price trend. Next is the daily and 52-week range. The day's range is an indicator of how much volatility is being released during the trading day. The 52-week range is the same indicator, but for the previous year. Also, it is common for a 52-week range to be a measure of a stock's trading range. A stock's trading range represents the stock's price support, or the price it has difficulty going below, and the stock's resistance, which is the price that it has trouble going above. If the closing trade is above or below the stock's trading range, then it is possible that a significant trend is beginning. The last significant number here is the daily volume. The volume of shares traded, like other fundamentals, should be an indicator that you are aware of and know that it can indicate many things. If the stock had a significant move on greater than average volume, it may signal a trend change. Additionally, volume is an indicator of stock liquidity. A transaction of stock or their derivatives, like options, is the same as a transaction of milk or bread. A buyer must want to buy and a seller must want to sell. A stock with low volume indicates that the number of buyers and sellers is low, and if the stock begins to trend bearish, then the ability to get out of the trade before all your investment is lost becomes more difficult. It is a generally accepted principle of trading to not trade a stock with less than 1 million shares of daily volume.